So it's the 1st of October and we have just entered the final quarter for 2021. Let's begin by looking at the US markets and let's start with the S&P 500. Let's take a look at what the charts are saying. So what has happened over the last month is that we have started another correction, one of many corrections over the course of the year. The only difference is that this correction so far has broken below the 50 moving average. For the first part of the year, you can see that every time we had a correction, we kind of like found support at that 50 moving average. And the market did not correct more than 5% throughout the whole of 2021. And of course, like I said previously, this can't go on forever because the market will eventually have to correct a bit deeper. And we have done that. You can see we actually broke below that 50 moving average. And we initially found support at this 100 moving average. We bounced up and this 50 moving average that was previous support became resistance. So it hit resistance and it looks like it's coming back down again. If we take a closer look at the technicals, you can see that the 20 EMA, the red dotted line, has crossed below the 40 EMA, which is the blue dotted line. And those of you who have taken my trading course, you know that the 2040 EMA, they measure the short-term trend. So when the 20 is below the 40, it means that the market is on a short-term downtrend, also known as a correction. But again, the medium and long-term trend is still up. So we are still in a bull market. This is just a short-term correction within a bull market. As long as the 50 moving average, which is this blue line, as long as this 50 is above this 150 moving average and they are not sloping down, they continue to be flat or sloping up, then the medium-term uptrend prevails. And as long as the price remains above the 200 moving average, which is this red line, and this moving average, the 200 doesn't slope down, then we are on a long-term uptrend. So again, we are in a short-term correction on a medium-term and long-term uptrend. And remember that in a bull market, you will have corrections anywhere from 5% to 15%, which is very, very normal. And corrections during bull markets are great opportunities to add shares of the index ETFs or shares of great companies that are fundamentally great and you've done your research on those companies. So far, let's take a look. So far, the market's down from the peak. It's down roughly about 5% from the peak. So where could it go from here, right? What are the next support levels? So I've drawn a few support levels over here. And so if you go to the weekly candles, let me just zoom to a larger time frame on the weekly candles, okay? So on the weekly candles, you can see that the next strong support would be the 50 moving average and the 40 EMA on weekly candles, right? You can see that this blue line is a strong support over there. So I've drawn that as a support, which is the 40-50 level, okay? Another support level at the 40 EMA at the 4139 level. So that's how I come up with these two support levels. And if you go back to the daily candles, you can see I've drawn a support at the 150 moving average. I'm sorry, the 150 moving average, the green line, because you can see that in the past, that 150 has acted as strong support in past big corrections as well. So that 150 is respected by the S&P 500, right? So again, we've got three support levels. As always, I say that we can never predict where's the bottom of a correction. We can never predict that, right? So there's never one time to buy. There are many times to add shares. So I like to add shares whenever it hits a level of support from an investment perspective. So the first target would be 4243. And again, you could find support and bounce off that, or it could still break down. So we have to see where it goes. Now, at 4243, this would represent roughly about a 7% correction from the top. At 4139, that would represent about 9% correction. And if it goes all the way down to this last support, which I think it may, then it'll be an 11% correction. And again, an 11% correction is still a very, very healthy correction within a bull market. And people always like to ask, why is it going down? Why is it going down, right? And that's not an important question, why is it going down? Because there are a million reasons why it goes down. Speculation, manipulation, algos, news, emotions, sentiment, millions of reasons. So as an investor or trader, it's not important to ask why it's going down. It's just recognizing it's going down and how do you take advantage of that? Because remember that the market is a breathing machine, right? It breathes out, it breathes in, it breathes out, it breathes in. It can't breathe out forever, okay? It's got to breathe in eventually before it can breathe out again. So it's part of the way markets move. And well, if you want to look for a reason, we'll talk about reasons later on. Of course, if you read the mainstream news, analysts will always pull out some reasons from their ass to justify why the market went down. So the first reason was the Evergrande crisis in China. It said Evergrande is a property developer. It could default on its debt, triggering a global financial contagion. So that kind of like was one of the reasons given for the initial sell-off. And of course, the most recent reason is because of the sudden rise in the 10-year Treasury yields, which are the US 10-year government bond yields going above 1.5%. So that's freaking the market out. And of course, another reason is because the Federal Reserve is saying that, hey, we're going to start tapering our bond purchases. In other words, we're going to reduce the amount of money we are printing. So these are all the reasons given, but it's not important. It's purely for entertainment and intellectual discussion. What's important is how do we take advantage of these corrections, all right? So far for the year, even with this correction so far, we are up on the S&P 500. We are up about, let me write this down. On the S&P, year to date, it's up, let me just get a figure. It's up 14.68%. year to date, right? So at the top, it was up about 20%, and now with this correction, it's up 14%, which is still much higher than the long-term average. So remember that in the long run, the S&P returns about 10% a year without dividends, right? So this purely without dividends, 10% a year. So as I mentioned before, in a long run, it's going to be 10%. So anything above 10% the market gives you, you will eventually take back, all right? So even at a 14% year to date so far, it's way above historical averages. It's in fact 40% above. So even if you drop all the way down and the S&P ends up the year up 10%, that's still a bullish year, all right? The other thing that you may also want to look at would be the monthly candles. Now, if you look at the monthly candles, you can see that, yes, a bigger correction is pretty much due, okay? Because again, look at the wave patterns, right? You got wave up, wave down, wave up, wave down, and wave up. It's been waving up for quite some time. We need a bit of a wave down to kind of like balance the waves, all right? And as of yesterday, we closed September with a bearish engulfing candle, right? That's called a bearish engulfing candle, which means there's a high chance we will see a bit more downside in the short term. So what should you do during a typical market correction? Well, it really depends again. Is it for your investment portfolio or for your short-term trading portfolio? Okay. So for investing portfolio, you're holding great companies. What do? You do nothing. That's right. All right. A lot of people think, hey, you know what? I'm going to sell and I'm going to buy back lower. And that's what everyone dreams of doing. But I can tell you that in the long run, if you attempt to jump in and out of stocks as an investor, in the long run, it will reduce your returns significantly. And I'm going to show you a couple of charts in a while, right? So as an investor, for my investment portfolio, I'm holding great companies, I'm holding indexes. Am I selling even though it's a correction? Of course not. I'm just holding it, right? Because I know in the long run, it's going to go higher. In fact, what I'm doing is I'm taking this opportunity, this correction to again add more shares of those stocks that I don't have a full allocation yet within that portfolio. So again, this is a really important study to explain why as an investor, you want to avoid jumping in and out of the market because you think you can time it perfectly, right? Sell it right now, buy it back lower, and so on and so forth, right? So let's take a look at this research. Now, what would have happened to an investment if you invested 10,000 into the S&P from 1980 to 2018? So that's 38 years. All right, so you can see that you just kept it in there for 38 years and did nothing. You would just ride the ups and downs. You would grow that money to $700,000. Okay, but within that 38 years, if you happen to miss 5 of the best days in the market, in other words, the 5 days where the market went up the most, you would have ended up with only 458,000, which means a 36% less than what you would have gotten staying in the markets. And if you had missed the best 10 days out of 38 years, you would have gotten half of what you should have gotten, right? If you missed the best 30 days, 81% less. And if you had missed the best 50 days over 38 years, you might as well have put your money into your fixed deposit savings account because it'd be 92% less, right? So the point is this, right? Now, 38 years is 10,000 trading days, right? So the point is this: if you think you can time the market by jumping in and out at the right time, you are betting that you can get in and out without missing 5 out of 10,000 days. So good luck with that. Or missing 10 out of 10,000 days, or missing 50 out of 10,000 days, right? So if you happen to just miss those 5 or 10 or 50 days, in the long run, you get significantly a lot less returns from your investments. And here's the interesting thing: the majority of the best stock market days have come in the midst of corrections and bear markets. Of the top 10 biggest gaining days in 38 years, 6 occurred during the 2000 tech bubble, or the 2000 dot-com bust, and the 2008 financial crisis. So again, while it's really tempting for some investors to want to, sell now, expecting more downside and buying back lower, I would caution against that. Now, for those of you who are also doing short-term trading in a short-term trading portfolio, then what should you do? Well, for my short-term trades, I'm still holding those positions because I have got cut loss levels for the short-term trades. So I'll only get out when they hit those stop loss levels. Until they do, I hold those long-term trades. At the same time, I could also take short trades in the market, and I just shared some of my short trades within the chat groups, like the Iron Striker group. As you can see, this was posted just yesterday, where I said that the 20 EMA has crossed below the 40 EMA. So I just bought some bear put spread options, where I'm buying the 430 put option and selling the 415 put option for $3.79. So essentially, this is a bet that the market will go down more in the short term, and I'm basically betting $1 to make $2.90, right? So betting 1 to make 2.9. So in trading, you always want to risk $1 to make $2 or more, right? So these are what we call short-term trades, which you can perform in your trading account to kind of like enter short trades during a short-term correction. Let's take a look at the Dow Jones, and you can see all 3 indexes are pretty much moving together. They're pretty much correlated. So on the Dow, same thing. You see that we have actually gotten the short-term downtrend as well, 20 below 40 EMA, but the medium to long-term trends are still up, and you can see that previously it found support at these moving averages, but now it's broken below those supports, and we are in that short-term downtrend as well. So for the Dow, year to date, it's up about a 10.58%, which is lower than the S&P, or 14%, but still a bullish year so far. Again, 3 more months to go, anything can happen. So remember that seasonality, September, October tends to have more bearishness. All right, so I'm not surprised that in the last 2 months, the November, December, we could see a huge rally where all these short-term losses are made back up. So you never know, right? It ain't over till the fat lady sings. So we're going to see what happens at the end of the year. But for now, we are still up 10% on the Dow. Now, how about the NASDAQ? For the NASDAQ, which comprises mainly the tech stocks, same thing. In fact, the NASDAQ has been holding up pretty strongly, interestingly enough. In fact, the 20 has not crossed below the 40 on the NASDAQ yet. And for the NASDAQ, it found strong support at the 100 moving average, which is this orange line. And right now is about there as well, right? Okay, so NASDAQ is up so far 12% for the year. Okay, so all three indexes are pretty much correlated, and so far the S&P is outperforming the Dow and the NASDAQ. If we take a look at the individual sectors within the S&P, you'll notice that basically every sector has been down for the last month. And it's been a mixed bag. It's a very strange market because you've got some of the cyclicals which are down, and at the same time you've got defensive that are down, and you also have technology which is down. So you can see that every sector is down except energy. So energy is the only one that's been up for the last month. In fact, energy has been outperforming for the year to date as well. And you may think, hey, let's go buy energy, right? So one of the reasons because oil prices are going up and coal prices are going up, and that's what's causing the power energy crisis in China. Now, you guys know that I don't like to invest in energy companies over the long run because, yeah, in the short term, there are pockets of time that it can really outperform the market. Well, one reason it's outperforming is because it has sucked for so long that it's basically outperforming from a very low base. That's the first thing to understand. The second thing to understand is, again, energy is something that, again, can perform really well in a short term and perform really badly in a short term as well. But in the long run, it's a sector which is really hard to predict in terms of the cash flows, and the companies within the sector are very, very competitive with weak economic mode. So although you can see that once in a while it performs really well, it's not something that I would want to invest in at all. For example, if you take a look at the charts, you can see, again, year to date, you can see that energy, which is the XLE ETF, the energy ETF, has, really gone up when the S&P has gone down, right? And again, year to date, energy has outperformed the market. But again, in the short term, anything can happen. And it's impossible to predict what's going to go in the short term. But if you take a longer term perspective, like look at the last 5 years, for example, you can see how energy really underperforms the rest of the market. And that's why it's something that I don't want to invest in the long term. You could trade it as a short-term trade, but not something you want to invest in the long term. If you go back even further, let's pull it back to the to over 10 years, back to 2011, you can see that, again, a very big divergence in energy relative to the rest of the market. All right, so let's take a look at the China markets. China can't seem to catch a break. And when it rained, it pours. So first we had the government crackdown that started early this year. And that, was the first catalyst that pushed the markets down. And then they cracked down on the private education sector. Boom, it's down again. And then they cracked down on the real estate sector. You've got this Evergrande debt default crisis. Boom, we're down again. And now we've got the China energy crisis, where there's a shortage of coal, as well as the government has, wanting to meet certain carbon emission targets, have told the cities to cut back on the power supply, and that's creating a short-term crisis, energy crisis within the country, right? So again, when it rains, it pours, and all this is causing a lot of negative sentiment towards the Chinese markets. So let's take a look at the charts first and foremost. And it's really the Hang Seng market that's been really bearish. Interestingly, the mainland China markets are still holding up pretty well, and they're still in positive territory. And that's why, for me, I've got ETFs that are equally divided between the GXC, which is more Hang Seng, and the ASHR, which is more mainland China. So, that's why it's really important to diversify between the two, mainland and Hong Kong. So looking at the Hong Kong markets, you can see that we are on a downtrend. We are in a bear market for Hong Kong, which I mentioned last month. So, we started the year. Let's see, let's click on the year to date. There we are. Okay. So, in fact, we started the year really strongly for just about a month, and then the crackdown started, went sideways, and we are now on this downtrend. So you can see the 20 EMA below the 40 EMA. So it's a short-term downtrend. The 50 moving average below the 150 moving average, medium-term downtrend, and the 200 moving average sloping down. So all the trends are down. So it is what we call a bear market, right? So in a bear market, you've got wave up, wave down. The wave keeps going down, right? So far this bear market has been it's been like 1, 2, 3, 4 months in the bear market. How long do bear markets last? Well, they could last up to a year and a half to even 2 years, right? So you never know how long it's going to last. But the good thing about this bear market is that in a way it is not a typical bear market that is driven by a recession. Okay, this is kind of like a self-inflicted bear market because of regulation. And the good news about these kind of bear markets is that the moment the regulation stops, or the crackdown stops, or you start to get some positive news, like better Chinese-US relations. Recently, the CFO of Huawei, Meng, was released by the Canadian authorities, and then correspondingly, China released the 2 Canadians. So the good thing is that the US and China relations seem to be improving slightly. All right. So I think that is going to be one of the triggers to trigger more money flow into China. And you need money to flow into China to reverse the markets back up. So I think that's one positive development. The second one would be, again, they're still cracking down, but the good thing is markets have a short-term memory. That's a good thing about it, that the moment the government starts to stop coming off all these regulations, this can turn around really fast. And again, there's no way to predict when it's going to turn around, right? Could turn around tomorrow, next week, next month. I don't know, right? My gut would say that we'll probably start turning around first quarter of next year, or first half of next year. It should turn around by then. But for now, the sentiment and the trend is still very much bearish. So for the Hang Seng Index, year to date, it's down 9.75%. All right. And always remember that markets are cyclical. Markets move in cycles, right? That, what is underperforming now tends to outperform later. So the worst thing one could do would be to say, hey, my China stocks are underperforming. I'm going to sell them, get out, and put more into US stocks. And if you do that, then next year you may have the other rotation where China starts to outperform and the US underperforms, right? So they all take turns. So what's important is that when something's underperforming, don't get emotional and sell. If you're holding on to good companies, you're holding on to the index, right? Hold it, right? And even add if it's not within the full allocation. All right. So like I said, for me, I already have, on average, a 25% allocation to China. So I'm not going to add very much more, although I would love to. But, it's keeping that diversification. I'm not adding more. Until I add more US, then I'll add more China in. So that's the Hang Seng Index. Bear market right now. We may get lower prices in the shorter term. Won't be surprising, but not too concerned, because the bull market will come, all right? Now, if you look at the Shanghai Composite Index, and I've got the ASHR basically to track the mainland shares. Okay, so you can see that the trend, although it's been quite erratic, it's still pretty much on an uptrend on Shanghai, right? The 20s above the 40, the 50s above the 150. So the trend is still up. In fact, Shanghai is up about 1.86% year to date. All right, so mainland China is holding up pretty well. Now, going back to that Hang Seng Index, and again, it looks pretty crappy on the daily candles, right? Because again, you can see that bear market here. But again, if you zoom out and you look at the longer term trend, and this is the longer term trend on the monthly candles, you can see that's the longer term trend. Okay, so long term, this sucker will go up, right? But right now you can see that there is a support there, right? And the good thing is it is pretty much near that support. So again, I'm not surprised that we get a bounce by the end of this year or the first quarter of next year. All right, just got to hang in there. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.